Great. Well, welcome to the second section of today's presentations. Thank you to everyone who came to the AGM. Welcome to people who've just joined us. I should say also that we're live streaming this event as we did the AGM. This is a bit of a new world for us, and so welcome to people who are joining us on the video stream. So really, you obviously got a lot of information about the year in the annual report. We tried to write pretty extensively about what's happened, what we've done. This is really to give a few different kinds of reflections on the portfolio, to talk a bit more conceptually about what we do, to explain a bit more about what we do and why we do the thing, why we operate the way we do, to give you a chance to ask questions. We're going to try and leave various opportunities for questions during the afternoon. So, as we go along, please do store up questions and ask us them. David and I are going to present first, talking about the portfolio and different ways of thinking about the portfolio. We'll have a little bit of time for questions after that. Then we've got two portfolio companies coming to present, Silica and North Coders, both very interesting, fairly new investments in the portfolio. And I hope you'll enjoy hearing from them directly. We'll then have a break, and after the break we have two of our new fund management teams in Amati coming to present. And I thought the reason why I'm hoping this will be of interest is that in Amati Global Investors as a firm, we've expanded our horizons. We were very much a UK smaller company specialist for many, many years. I grew up as a fund manager working in a firm which had teams from studying things all over the world. And have always had it in the back of my head, it'd be great to recreate that in Amati. And we had the very good fortune to be able to take on two new teams who just give us additional dimensions of research and thinking that feed into our own thought processes. So after the break, there'll be a chance to hear from them. So you can get the flavour of really how we operate as a firm and the range of things that we cover and think about. So I'm going to start just by looking at the long-term history of the performance of the fund. This goes back to March 2010, which coincidentally is roughly the time that we started Amati Global Investors. We actually started it in January 2010. Those of you who've known me a really long time will know that actually I became a VCT manager in 2005 when I started First State AIM VCT at First State Investments. And the reason this goes back to March 2010 is because when we did the merger of our two Amati VCTs, we had to choose one to become the surviving entity, and we chose this one. And as it turned out, this was one we took over the management of in March 2010. That's why this goes back to there. It's from when we've been running it. What you will find on our website, if you want to have a look at it, is what this graph looks like if you go back to March 2005 and you were, as I was, an original investor in the First State AIM VCT. As you can see, it's been really a pretty difficult year, very disappointing year in many ways. It's been a tough time to be investing in early stage companies, new businesses, small companies in general. I'm not going to dwell into all the reasons because everybody in the room knows pretty much what's been going on and why conditions have gone from being exceptionally strong in 2021 to pretty distressed where we are now. One of the only thing I will mention is that, because this isn't so much written about, that one of the features of the pandemic was that very, very large sums of money got created by central banks, and so where did the inflation problem that is in everybody's face come from? Actually, one of the principal causes of that was overprinting of money in 2020. And it was essentially a policy mistake made quite widely, certainly in the UK, even more in the US and Europe. To a degree in Europe as well. Money creation is a bit of an abstruse topic. It's very rarely talked about. It's probably more a determinant of GDP growth than interest rates. Interest rates are assumed to be the thing which drives everything. Actually, money supply matters hugely, and we went from a massive abundance of money supply in 2020 to the situation we're now in, where it's constricting. It's not growing at all. In fact, it's contracting, and that just means there's less money around for investment. and liquidity feels tighter. It's harder for companies to raise money, and that trend of it being a bit more difficult for companies to raise money probably carries on somewhat. I mean, another way of seeing what we've been through, of course, is that which one of these is unusual. Actually, 2020 was the unusual one. That was completely unprecedented. We'd never created that much money any time since after World War II, and so it was a pretty extraordinary event, and we're in the aftermath of it. And it's the consequences of normalization is the way to think about it. We've normalized interest rates. We've gone back to a more normal world of inflation. Of course, it's overshot. I think inflation will come back down, but it will still be much more present in our lives than it was before. This is just how conditions were for a long time before all of that happened. And I think from a small company investor point of view, life as a small company investor is normally quite tough. It's in the nature of small businesses to have amazing ideas, and we get wrapped up in them and we want to support them, help them grow. Actually turning those into properly successful commercial enterprises, it's a long and difficult road. There aren't many shortcuts, and of course the market's view of this is a bit schizophrenic. We go from times when the market's just going to assume, this is almost already happened when it's only just beginning, to then thinking, well, it's never going to happen, and everything's doom and gloom. And so you swing between very hot and very cold. And it just so happens over the past year and a half, it's been a brutal swing from that world of really fairly intense optimism to now one of the opposite. So it's in the bipolar world of stock markets, we're at the depressed end right now, and and that's tough. And I guess we set out our stall in Amati AIM VCT of being really long-term investors in the companies that we back, and that can be difficult at times like this, because we tend to stick with our holdings for long periods of time. Our sell discipline for companies is rather different from any other kind of fund, because we know if we sell a holding in the mature end of our portfolio, we can never reinvest in that stock again. We don't have the luxury of other funds of, I think this is a bit expensive, I'll sell it and I'll just try and buy it back in a year's time. We can never buy it back again. We invest when companies are really beginning, and our objective, if you like, is because we want to allow the portfolio not just to be made up of very risky new early stage companies. We need some of them to mature and become bigger businesses, and they then create the balance in the portfolio that we're after. So one of the things I want to go in and look at is just how to think about this portfolio of investments. I've talked a lot about this in the past. Where are we up to with the kind of on that spectrum? Before I do that, I'll just mention the dividend policy. This is a sort of one constant that we've always said, through thick and thin, we aim to pay 5% of our year-end NAV out as dividends. It means that in good years the dividends go up, in bad years the dividends go down, but it's a predictable and consistent policy. And we totally recognise that VCT holders, one of the big benefits is you get tax-free dividends. We don't want to abuse that by just paying out everything we possibly could, because that would be deeply upsetting to the policymakers. But having a very consistent policy, I think, leaves everybody knowing where they stand, and it makes it pretty straightforward for us to know how we're going to manage the cash from that point of view. And so that's been very consistent over the years, and it remains hopefully a constant. I just thought, Bob, as we start thinking about what's the shape of this portfolio, how does it look? This is the list of the top 20, actually, as it stood at the end of May. So this is a bit more current than is in the annual report. And you can see that this is dominated by many holdings that we've held for a long period of time. Keywords, 2013, AB Dynamics, similar. Age of investment, learning technologies, similar. Couple of newer investments, Polarian slightly newer. Origo is very new. That's a bit of an anomaly being in the top 10. Origo is a very rare thing. It's an IPO from last year that's gone up a lot, so that's why it's appeared in the top 10. And then these other ones are mostly older. Silica, you can see here, has also crept into the top 10 holdings, but in the bulk of these are long-standing, in many cases really quite mature companies. This is a method of presentation that we've used for a long time. We call it the bubble chart, and the size of each bubble is one investment in the portfolio. The size tells you the size of the holdings. So the biggest ones are the top holdings. And then on the bottom, you can see the year of investment. So these go back actually all the way to 2002. And those of you who are remembering what I said earlier about I started managing a VCT in 2005 will say, well, how could we make one in 2002? Well, this was a VCT we took over and we inherited this holding. It's actually, I think, Accesso there. It's a very, very long-standing holding. And you can see the names and you can see how actually it's still the case that we have many holdings in the portfolio that are multi-hundred million market cap companies. And that's because we've held them for a long time. We've let them grow. Clearly, in terms of the performance, both parts of the portfolio have suffered. These older, more mature companies have been derated. Some of them had some trading difficulties in much tougher times that we're in. And the newer holdings are suffering just because the market is now very risk averse and the liquidity that's available for these newer type holdings is much reduced. So I thought it'd be interesting just to then try and divide up a little bit randomly. This is just our view, purely a very subjective view of the portfolio. What we call early, we've got a couple of private holdings, which I'll talk a little bit more about later. It's a small chunk of the portfolio, but then we divide them up between what we call early stage. So these are companies which are really still very small, perhaps still loss-making. Their business plans are still kind of out there in the future, probably consuming cash. We've got some what we call halfway, where actually the commercialization process is now really kicking on and they're on their way to becoming what we would then term mature companies. And then big chunk of the portfolio in these older investments that have, if you remember that bubble chart a minute ago, these have become really quite significant medium-sized, small and medium-sized companies. And that's the lie of the land. And then a really big chunk of cash, which is why we didn't raise any money in the last tax year. And the theme there is that deal flow meaning investments that we could make, qualifying investments we could make on AIM, has really slowed down. And there is more to say about that topic. There's quite a lot written about now about the balance between public and private markets in the UK. A lot of concern about the public markets in the UK, rightly so. There are some real problems that need to be addressed in the public markets. One of our investors, Robert Leggett, earlier was mentioning about the Edinburgh reforms. Some of those are designed to address problems in the public markets. I personally don't think they've diagnosed all of the problems entirely correctly, so there are some that remain. But it's one reason why actually our cash level is higher than we would have reckoned on being. We're not under pressure to make new investments, so we're not going to spend that money on investments we don't really want to have. And that's very important. But it's still ample cash. It's a big chunk of the portfolio. And so you can see, actually, the early stage part of this is still only 20%, but it's taken quite a lot of performance pain over the period. And even the mature part of the portfolio has also been derated. Obviously, this is, I think, a reasonably accurate portrayal of the risk profile. So mature, yes, you get deratings, but actually these companies, they're not going to go out of business. They have setbacks and they bounce back. When markets pick up, it's likely to be that it's this mature part of the portfolio that picks up first, and then as confidence returns, investment confidence goes back into the smaller end of the portfolio too. So that's the kind of lie of the land. If we translate that into this bubble graph, this is how it looks. So you can see here these gold bubbles are what we call the mature companies, many of them old investments, and this is really why we like to hang on to our investments really for a long period of time, so they get to that stage. And then of the newer ones, you can see some of these are what we call halfway, so they're making really good progress. We can see that transition really now kicking off. And then of course a lot of the newer investments still early stage. You can see one or two of the older ones are just stuck as early investments. It means they just haven't done what we were hoping they were going to do. Sometimes, there's one company I can think of in the portfolio. We invested in it, I think, 15 years ago, and it's only now just gone into the halfway category, and it's actually now looking really promising, but we've had to kind of ride it be incredibly patient, and what it's been creating is very difficult, and hopefully it will now kind of blossom into what we always hoped it would. And then just very quickly, while we're sort of thinking conceptually about the portfolio, another way of thinking about it is along themes. So we talk quite a lot about these themes. Digital technologies has been one of probably the dominant theme of investment over the last 12, 13 years, since 2010. This was a very profitable strand of investment as companies apply digital technology in a novel way and manage to then build really good businesses on the back of them. This is the lie of the land of our digital technology portfolio. As you can see, a lot of our mature companies in the portfolio are of this type. They're built around digital technology, but we do have some newer ones here. And North Coders you'll hear from later. Fadel's the newest holding in the portfolio. That's a recent float on AIM, and that's a software business, an interesting company. We'll talk more about that another time. SRT, which we got here, this is one where that's the one I was just talking about. It's taken 15 years, but they just announced a $180 million contract, a completely transformational contract for the business. It's taken them 15 years to get there, though. So, it just shows actually we have to be able to think in long terms. Creating businesses is hard work and it takes a long time. So, and it's nice when you eventually see things like that happening. Healthcare is the most difficult segment of our portfolio. We had huge optimism about this in 2020, and it was right in fashion in a way in 2020 in the pandemic. Actually, the norm in healthcare is that this is a very, very difficult sector. We can talk, I'm very happy to talk afterwards about why this proves to be so difficult. It's partly because the timelines are so long, the capital requirements are very big, and we've only really got one company here that's made it to what we call profitable and relatively mature business. We've got a few well on the way, and we've still got quite a few early stage where there's still a significant long road to go to get to where we're trying to push them. And then environmental technology, this is a big theme in the portfolio. We talked quite a lot about it. I think whereas digital technology was 10 years ago, 2010, just really took off. Environmental technology, it's what everyone's thinking about. It's not surprising that there's a fantastic number of new companies that are focused on this. There's a massive industrial revolution required to bring about energy transition, to change the way the world works, if you like, if we're going to avoid global warming. And there are thousands and tens of thousands of companies who have providing little pieces of that puzzle, and it's a massive puzzle. But it's also, we're very early days into this, and it's not yet clear how this all shapes out. We've got a few companies that are quite mature here, and they're some like AB Dynamics, an engineering business, has a lot of new business based around electric vehicles. It's a testing company. But we also have plenty of newer ones where they're providing sort of more directly related kind of environmental technologies. It's been a tough business. This is a segment of the portfolio where we are going to get a few red herrings. We're not always going to get the choices of which technologies to back right. We're still early on. This is probably, if you think about the way the internet boom worked in 2000, that was probably the equivalent of 2020, and we're now 3 years post that. Probably in 5 or 6 years' time, it's going to be much clearer who's going to win out in all of these different industries. There's clearly a major international battle going on for which countries are going to successfully capture these industries. The UK wants to play its part. The US, as you know, with the Inflation Reduction Act, has very clearly set out its stall to be quite protectionist and say we want these businesses to be in the US. Europe's about to try and do the same thing. The UK wants to do its own version. It's obviously part of the role, if you like, of VSTs and our tax privileged structures to play our part in this. But it's early days, and the UK has fantastic innovation, loads of ideas, lots of opportunities. Selecting the right businesses and which ones of these are going to win out is, it's our job. Not all of these are going to be the right ones, but hopefully some of them really will be. So that's the lie of the land. So with that, I'm going to pass on to my colleague David Stevenson, who'll talk about some other aspects of the portfolio. Thanks.
Good afternoon, everyone. We're often asked whether our portfolio necessarily has to have a high concentration of UK-based businesses, companies that generate a high proportion of their revenues in the UK. And you'll see from this pie chart that is the case. We do have more than 40% of the total revenues in the portfolio coming from the UK. But we invest with the idea that we're looking for companies that have products or services that have global potential. We're investing in UK smaller companies because we want them to be bigger companies, and we're investing in them because we want them to be international companies. And that's certainly the case with the more mature holdings in the portfolio. Some of the names that Paul's already mentioned, AB Dynamics and Keywords, those are truly global businesses and generate revenues internationally. You've seen the themes analysis within the portfolio. This is a more classical analysis of the portfolio into individual sectors. These are standard descriptions, and you'll see from the left-hand side the biggest weightings in information technology and healthcare, which mirror a couple of the themes that we spoke about earlier. In terms of our environmental technology and services, those businesses tend to be scattered across a range of sectors. They cover materials, energy, industrials, and even consumer. AB Dynamics is classed as because it's automotive related, is classed as a consumer business. So we do have concentration in IT and healthcare, but a very broad spread otherwise of different companies in different sectors. A couple of slides here on what we've been doing really over the last couple of years in terms of investment activity. Despite the difficult conditions that Paul's already described, we've managed to maintain a good run rate of investments. Two of the names on the slide, first slide here, North Coders and Insilica, you're going to hear from later. So those have been successful investments even in these difficult times. And we're still investing in both these years in the key themes that Paul's already described. Those themes in total, the three that were mentioned earlier, represent about 50% of the portfolio, and we're still finding ideas, as you'll see from the activity column on these charts. We're still finding good ideas in those broad themes. So you can see the diversity, and in fact, healthcare not featuring quite so much over the last couple of years. As Paul's indicated, there was a hiatus of activity in and around the pandemic. A lot of healthcare companies came to the market. They don't feature as heavily in our pipeline at the moment. Intelligent Ultrasound is a medical device company with artificial intelligence in ultrasound devices and simulation. So that was a follow-on investment in what was already a successful company. You'll also see that new investments tend to dominate the pipeline over the last couple of years relative to follow-on. This is a picture going back over the last 10 years. The top line shows the number of opportunities that we've actually looked at, our pipeline, if you want to call it that. And beneath that, the number of deals we've actually participated in, both in new companies and also follow-on deals. And as Paul mentioned earlier, you'll see that 2021 stands out within that 10-year profile as a year of very, very significant fundraising activity. A lot of companies came to the market in and around the pandemic to raise money, some for good reasons, some for less good reasons because they were burning cash at an alarming rate. 22 and 23, we've seen that pipeline of activity settle back into a more normal historic pattern, and on a pro rata basis, 2023 is pretty much the same profile as 2022, and we have been busy. We've managed to invest in a range of things that you saw from the previous two slides over those 2 years, predominantly in new companies to the portfolio, which we're very, very pleased about. As Paul said at the beginning, it's been a difficult year. There's no getting away from it. We'll deal with the positives first of all, the companies that have contributed significantly over the last year. This is up to the end of May, so it covers beyond the financial year end. Delighted to see a company like AB Dynamics, one of the older, larger holdings in the portfolio, still contributing significantly. As Paul indicated, AB Dynamics is a specialist in automotive technology. They are right at the forefront of helping car manufacturers develop new technology on board with cars, existing fossil fuel cars, but also for electric vehicles. They're at the forefront of driver assist systems. If you drive your own cars now, you realise that you have cruise control, you have parking assist, you have lane controls, you have lots of things that I find incredibly annoying. But AB Dynamics is involved in the development of that, as well as autonomous vehicles. They do testing, simulation and measurement, both hardware and software, for the development of the next generation of electric autonomous vehicles. Origo, Paul has mentioned, relatively uniquely a great IPO in a very difficult environment. Origo is still in the early stages. Origo is also in autonomous vehicle technology. They have developed autonomous trolleys which are used for baggage handling at airports. I spent a while waiting for my late departure of the flight in Edinburgh, watching diesel-driven buggies being driven rather erratically by operators around the airport footprint, occasionally bumping into aircraft. What Origo has developed, and it's at the testing stage at Changi Airport in Singapore, which is the biggest international hub, and they tend to be an early adopter of technology. They have developed autonomous dollies which will do the baggage handling instead of humans. This has the benefit that these are electric buggies, so it removes the diesel carbon footprint, and it also removes or eases the labour shortages that a lot of international airports have. The autonomous dollies will work 24/7 and don't go on strike. Diurnal is an example of a company that's bid for within the portfolio. It was involved in hormone deficiency drugs, taken out by a US peer at a substantial premium. What's not on this slide is a company that Paul mentioned earlier, IdeaGen. With this 1 year rolling time period, it was taken out. It was a company involved in GRC software, which is governance, regulation and compliance. It was taken out by a US private equity group, again at a substantial premium, and at that point it was the biggest holding in the portfolio, and is part of the reason why we have heavier cash within the fund at the moment. The negatives. I'll just touch on a few examples here. Polarian has at various points in the past been the biggest holding in the portfolio. Frustratingly, Polarian is a medical device technology company that has a product where the technology works, and it has achieved FDA approval at the end of last year. Unfortunately, that FDA approval was 18 months late, and the consequences of that were quite significant for the company's ability to invest in its future growth and also to finance that growth going forward. That commercialization delay was really significant, and not really much the company could do anything about. We're obviously, it remains a large material holding, and we're very close to it. Sayeta, disappointingly, having been one of the success stories of this event last year, I think you may remember it presented a year ago, has sadly given up all of its gains in the last year, despite making significant operational progress. It's a company involved in electric drive systems for electric vehicles, and it's achieved a number of milestones over the year. They've got secured a UK manufacturing base. They've signed partnering agreements in the US and India, but the early stage nature of that business didn't fit well with the risk appetite in the market last year, and the company's been very significantly derated, but we are positive about future prospects. Frontier Developments, one of the longer term, more mature holdings, is a developer and publisher of video games. During lockdown, the video game market globally grew exponentially. People stuck at home with not much to do. That actually, unfortunately, encouraged a lot of content to be published, and the after market we've seen since then is that excess content publishing of games has created a very, very competitive market, and sitting alongside slowing consumer demand more generally, Frontier has suffered from a trading point of view. Angle, another medical device company where we felt that the initial investment premise was in danger of being superseded by new blood diagnostic methodologies in the market, so we decided to sell out of that one. And also the last name here is actually our smaller companies fund, our OIC, and the fact that it's on the screen just represents how difficult it's been for UK smaller company investing over the last year. As an asset class, UK smaller companies have been derated quite aggressively in a global context. I'd like to finish off quickly with some graphs which speak to what Paul was saying earlier about how some of the more mature holdings in the portfolio have been significantly derated over the last couple of years. I'll explain. There's 4 companies here, 4 sets of graphs. The top graph, the black line is the share price of the company. The coloured lines above that show the earnings forecast momentum that the company has produced over the last 2 years. And this is rebased over 2 years back to 100. So the feature that you would want to see is positive earnings momentum upgrades. There's 2 lines because it covers both the financial year the company is in and a forecast 1 year out. So ideally you want your earnings momentum, your earnings per share growth to go from bottom left to top right. And in normal circumstances, share prices react positively to that, and your share price momentum would also be bottom left to top right. What you see here, though, is a decoupling of that, with the share price momentum significantly underperforming the earnings growth that the companies are producing. Now, the arithmetic outcome of that is the lower chart, which is the price earnings multiple for the company, the expensiveness of the company. If your earnings are going up and your share price is going down, then you're becoming a cheaper and cheaper company. And you'll see here with Craneware, which is a specialist in US healthcare software, the company has produced really good earnings momentum over the last 2 years, but the shares have halved in rating down to just over 20 times. And it's a similar picture on these subsequent graphs. Keyboard Studios, which is the largest holding in the portfolio at the moment, it's a company that provides on a global basis outsourced services to video game publishers. They do things such as testing of games, translation of games, they do artwork for games. And again, a company very significantly strong earnings momentum over the last 2 years. The shares have not connected with that, and as a consequence, the rating in the company has slipped below 20 times. It's never been as cheap in the last 2 years. Another graph, the same picture, Landing Technologies, another one of our mature holdings, down to 12 times in multiple terms. And finally, Water Intelligence, which is a company involved in water leak detection, remediation and repair, an international business, very significant business in the US, where clearly water leak management is absolutely crucial. Again, a company that's produced good earnings momentum, but the shares again down below 20 times. What we're trying to get across here is that we see upside in the portfolio not just from the new investments that we're making and the new growth stories that will drive the performance of the fund over the next 5 years, but we see very significant untapped potential in the performance of these mature holdings, where because of the overall smaller companies environment, the shares have been, we would say, unfairly derated in that 2-year timescale. That really completes the formal presentation, so happy to open up to Q&A. Paul, if you want to share that.
Yes, we've got a brief little period now. If anyone has any questions on anything we've covered or things we haven't covered, please do fire away. I think you got your hand up first here. So
could you tell us what your attitude is to top slicing? And in the peak years of 2021, did you do any of that?
So the question is about top slicing. Did we do any top slicing in the 2021, and what's our attitude to it? So I should say we do have a roving mic, so we'll try and get the mic to the questions. We did a little bit, and I suppose our view of it has in the VCT is to sell businesses when we really think we've had everything out of them we're going to get out of them. We do try and take a long-term view because we want the more mature businesses in the portfolio, and the only way to get that is to ride some of the ups and downs. So we're not aggressive about top slicing. We do some of it, and we have done some of it. And I suppose, having been through the last couple of years, I'm thinking, well, why didn't we do a bit more of it? And of course, it's a fair point. So maybe our propensity to do that has kind of risen a bit. But it's the nature of the way this particular product works. Is if you want to build up this maturity profile that we've got, it's a trade-off. To what degree do you kind of jump out and it feels good for a while, but then actually, if 5 years later the company is much bigger, you kind of think, well, why did I sell that? So that's the kind of calculation we're trying to do, and it's not an easy one, and we're not always going to get that right. So thank you. I'll take the question just behind here. If you just wait for the microphone to come. Yeah.
I think mine's almost the reverse of that. On your slides there, where you see such a low PE, do you not think about going back to buy up, double up on some of the investments if they've got such a low share price?
So then the problem is that the way the VC rules work, we're not allowed to buy these investments again unless they're raising money. And when they raise money, it's got to be qualifying. And if they're a mature business, it won't be qualifying. So we are having to kind of think very long term, say that's the position we've got. We maybe own 5% of this business. We're just going to stick with it. And yes, there's going to be some ups and downs. But as long as we kind of feel that there's a bigger prize in the future, then our propensity is going to be to hang on. Yes, no, I think the gentleman in the blue shirt over here was next. Thanks.
Looking at the numbers, I think we all understand the markets, but clearly you failed to beat the benchmark essentially over the last 5 to 10 years, and essentially suggests to me that anybody could have just put a pin in the A market and got a similar result. How can you demonstrate to us that you're really adding value, and that really, and how are you as an organisation really trying to improve your game? Because I think we would have expected, like a lot of other VCTs, were significantly beating the market.
Okay, that's a good question. So about the benchmark, we have actually beaten the benchmark over 5 and 10 years, but shorter term we haven't. But on the other hand, what I would say is that we have a benchmark which is the whole index. And it's not necessarily a very always a realistic. If we beat it, I'm actually always delighted, because if you think about it, if you're just investing in the index, you can buy any share you like any time. We can't. We have to buy a very small subset of time shares only maybe once or twice. And we have to buy them right at the beginning of their lives. And I hope we've got them, we're predicting accurately 5-6 years out, they're going to turn into what we want them to turn into. By the time it becomes clearer, this is going to be a great business, we can't buy them anymore. So it's the nature of the VCT discipline is really completely different to any other kind of fund one might have. Of course, that is why there's a tax benefit here, because the tax benefit is all about filling that what's called the equity gap, where there aren't enough investors at the point we're investing, and that's why there's a tax incentive to do it. But the discipline for us is to then identify companies that years down the road are going to become much bigger businesses. But it's really not like investing in it's not like the benchmark doesn't really reflect that at all. Where with the benchmark you can spot a great business and just buy it whenever you like. We can't. We normally have often we only have one chance to make an investment in the company. That's it. It's very binary. Either you do or you don't. And if you don't and it's a great business, you're going to regret it for a very long time, and there's nothing you can do about it. If you do and it's a bad business, you're also going to regret it, but it's in a different way. So yes, it's a good point. I'm very pleased we have beaten the benchmark over those long times. Over 3 years we haven't. But the comparison is not straightforward. Thanks. And I'm going to take one from this side of the room because there are fewer on this side. So if we go to the gentleman over here.
This is a VCT. Do all the companies that are within the portfolio qualify at time of death?
So this is not about, are you referring to inheritance tax here? So yeah, VCTs are not an inheritance tax product. So, so if you own, so in a sense, the question over whether these qualify as business assets if you were to die, if you own them directly, some of them will, and one or two of them won't do. And the tax advice around that is a completely different sort of topic. But in general, most of them will do.
And the selection you've got there,
Yeah.
you obviously they don't all qualify.
Well, it's not a question we ever have to ask ourselves. We do, as you know, Amati runs an inheritance tax portfolio service where all of those companies qualify. For these ones, a lot of them will because they're AIM quoted. There may be some that don't, but we don't have to ask that question with the VST, because when we talk about qualifying in the VST, the only thing we're interested in is, do they qualify for VST?
With respect, that's not what you're just interested in. You've got people who are investing. You've got octopuses of arrival, and there are others out there coming along. Now, there is, for people of my age group, we need to know whether they will qualify for inheritance tax or not. It's a matter of our judgment at the end of the day.
No, I think I maybe misunderstand. This product does not qualify for inheritance tax. None of it does. This is not an inheritance tax product. If you were to buy some of the companies in our portfolio individually yourself directly, some of those would, but this product is not inheritance tax free. Okay. Let me take one near the back. So, gentleman near the back there.
Two questions, if I may. One, do you see the private equity coming a bit more in, or are you limited by the objectives of the fund that you can't really have much private equity, or could you see the amount of private equity growing? That's question number one, if there are not many flotations, obviously.
Yeah.
And the second question is, there's been quite a surge in the big tech stocks, particularly in the US. Is there any evidence ever that if you see such a surge, it will come to the smaller companies in a sort of pretty reasonable time, or is there just no connection at all? I mean, it's been quite extraordinary how tech has really come back into fashion. And basically, absolutely. This is a sort of tech fund, isn't it?
Yeah, both very interesting questions. So let me take the first one on private company investment. And this is something that we sort of stopped doing altogether about 3 years ago. And as you can see, you'll have seen on the graphs, we have a few private company investments. And it's an area we're exploring again, in part because of the dearth of companies on AIM. It's also in part that there's a bigger picture thing going on, and it has been going on for a while, that a lot of the companies that would have floated maybe 10 years ago are no longer choosing to float, and they're raising their money in the private world. And with the mode of operation that we had, we just simply don't get to see them. And so with that in mind, we have begun cultivating a policy where we do some private investments, but you then very rightly say to us, yeah, but what do you know about investing in private companies? It's a very different discipline. And so we have put in place some significant disciplines for making one or two investments ourselves. But in fact, the most recent one we made, which is a company called Manufacture 2030, we made with a co-investment with Maven, who are obviously a private company specialist. And in some senses, we were able to then benefit from a very long-standing kind of methodology of making those type of investments. So I think in terms of the future, if we were to find that the AIM market doesn't kind of right itself and become the place where we're going to see the right kind of deals coming of the quality that we want to invest in, then we have a bit of an each-way option to maybe do some more private company investing. And if that, depending on how that goes, and this is really very much an open question, and it'd be interesting to talk to somebody afterwards to find out what your views on this are. I think ultimately, if we were to start to feel, well, actually, the opportunities of that type are stronger than the opportunities we're going to start seeing that are coming through on AIM, then of course we may want to look at our investment policy. As it stands at the moment, our policy is very much when we're investing in private companies, it's with a view to them becoming floated companies down the road. Obviously, that doesn't always happen, but that's our kind of thought process and intention. If if the way this market is going to evolve is that, actually the best deals we're seeing are in the private company arena, and we want to do more of that, then we maybe then revisit the policy and put that to a vote. So it's a bit of an outstanding question in our minds, and at the moment we're at least wanting to have some options that go beyond the AIM market in case this situation doesn't really change. And obviously I hope it does. I'm a huge believer in public markets, not least because if you think about it, I'm sure this applies to everybody in this room, public markets are the primary way that the general public has to save in something that's more productive than just putting money in the bank and earning an interest rate. And it's massively important for wealth sharing across the whole of society. If you don't have public markets, then actually only very sophisticated investors who can handle private company investments well have any chance of making, benefiting from the growth of the economy. So, I do very much hope this does right itself, but we are, to a degree, cultivating some other options just in case we need them. So thank you for that. And the other question about the tech rally in the States, which has been remarkable, but incredibly narrow, and that's been written about a lot. 7 companies have generated nearly all the returns, phenomenal returns actually in the first part of the year on the NASDAQ. Does that broaden out or not? Sometimes it does, sometimes it doesn't. So I'm not, it's too early to tell. Obviously, I hope it does. I wish I knew the answer to that, and I'm afraid I don't. Yeah, thanks. And let's take one more. There will be more time for questions later, but we'll take one right at the back of the room, just here. So I will maybe answer your question at the end. Thanks.
Thank you. Any spin-out coming out of Oxford University has to go through a company called Oxford Science Enterprises. Yeah. Oxford Nanopore, Vasitec, etc. Do you get access to that investment body, as in investing in OSE? Yeah. Or any of the companies that come out of there?
No, the answer to that is we don't. And the kind of companies, the kind of rounds of investment that they would be doing probably wouldn't really be suited to VCTs. That's not really, it's not really a VCT kind of shopping arena. But for one reason is that, this is a, for those who don't know, this is a technology fund set up around Oxford University, has some huge institutional investors, global sort of, pension funds, or I think a Singapore wealth fund, and some very big institutions. So they will typically be raising $50, $100 million in a round. That immediately puts it beyond the realms of what a VCT can do, where we have strict asset limits. And so that's not a game we play. And also they will very definitely be private companies, not public, and really for quite a long time. So yes, the answer to that one is no. But I suggest we do that, and I know there's other questions, and I obviously want to answer everybody's question, but let's move on to our company presentations, and there'll be time, certainly over coffee and in breaks, but also right at the end of the session for more follow-up questions. So thank you for all of these questions.
Well, further to one of the questions that was asked earlier about tech within the UK, I'm delighted to introduce the first of our company presentations, a recent investment in the portfolio in Silica. And Silica is one of those rare things. It is a UK semiconductor designer and supplier. It specialises in, and I'm going to get in my depth very quickly here, it specialises in ASICs, which are application-specific integrated circuits. So a very specialist end of that semiconductor market. And I'm delighted to have both Mark Hodgins, Executive Chairman, and Ian Lancashire, CEO, here to tell you more about it.
Right. Where's he? Oh, there he is. I'd like to start by saying a heartfelt thank you for your support. Last year we did an IPO in May, and I can tell you in the first half of last year there were very few IPOs done, and we're very, very grateful for the faith you showed in us. Thank you very much. Bit of housekeeping. I'm going to try and get through this quite quickly to keep on schedule. We'll do the questions. Our slot will be 10 minutes of me presenting and 10 minutes of Ian answering your questions. So if we can leave the questions to the end, that would be great. And normal disclaimer, I'm going to talk about some forward-looking statements that involve substantial risks and uncertainties, and actual results and developments may differ materially from those expressed or implied in those statements. You can tell a lawyer wrote this, can't you? I refer you to the useful disclaimer, which I'm sure you've all seen before. So this is a presenting team, which I'm not going to spend any time on. You can read, you'll have a copy of the presentation, you'll be able to read that later. And we'll get on to about the business. So, what is an ASIC? So an ASIC is an application-specific integrated circuit. It is a custom chip designed for a specific purpose. ASICs are used in a wide range of applications and have considerable benefits. They are differentiators. They can address lower power consumption. They have smaller form. Generally, they're lower cost but larger volumes. They give higher functionality. They provide improved data security, supply chain resilience, and IP protection. They're very useful chips to have in your armory. They are used by leading companies to differentiate their products, and they are also used when new technology is introduced or developed, such as next-generation automobiles, the connectivity of the Earth to low Earth orbit satellites, industrial IoT automation, AI, smart healthcare, 5G. It's all coming, and ASICs will play a part in all of those things. Ensilica was formed 22 years ago by this gentleman on my left as a design consultancy and changed its business model in 2016 to its current model, which is that of a design and supply of silicon chips, in our case, ASICs. Note, we do not manufacture the chip itself. That would be a very expensive investment to make. And like many other companies, we subcontract that work to the chip foundries. And I don't doubt there'll be a question about Taiwan in about 10 minutes' time. We describe ourselves, as many others do, as a fabless chip manufacturer. Many companies have adopted this business model in the past to great success. So, a bit about us. In summary, Ensilica is focused on becoming the premier application-specific chip maker in Europe. We believe we have a strong existing foothold in the marketplace. We've been doing this for 20 years. Our business already supports a global client base, and we have an experienced management team, which we are building on all the time. And we have a good track record of delivery from about 140 employees across 3 continents. I'm probably going to jinx it now, but we've never failed to tape out a chip successfully. And that's because we make sure we get it right first time. The global market for semiconductors is vast, and forecasts for the end of this decade show that the market for ASICs alone will be worth $29.3 billion, which is a growth of 36% over the period from today. Within the ASIC market, we are trying to show that we're focusing on high growth opportunities in automotive, industrial automation, healthcare, and satellite communication sectors. And I'm going to go on about this a little bit because it's quite important. I will address the opportunities in each of those sectors shortly. We have a growing pipeline, we've got a good order book, and we consider ourselves to be experts in the complex mixed signal chip supply, which is a proven model for success. So what makes us unique? Our USP is a mix of our accumulated intellectual property developed over 20 years, which, as I have said, is focused on mixed signal and RF technology. This is at the difficult end of the gene pool when it comes to designing chips. Secondly, we have our business connections in the industry developed over 20 years as well, again, specifically in mixed signal RF focus. And we have a highly knowledgeable and experienced workforce. We have a large proportion of PhDs working for us. We have a good and growing reputation in this area. There are quite a lot of opportunities to address. Our experience with our IP addresses some of the highest growth markets in the sectors. As mentioned earlier, our focus is, as I've listed, automotive, industrial, healthcare, satellite communication. And this slide gives you an idea of the size of the markets we are now penetrating. We have business in all these markets. We've got quite a lot of business in automotive. We've got some very interesting opportunities in satellite communications. We've got our own chip in healthcare, which hopefully will be generative in the next 12 months. And we won a big order, you might have seen, very big order from an industrial automation company last year, $33 million contract last July. So focusing for a moment, we think EnSilica is particularly well positioned to capitalise on the satellite communication market. We have significant contract momentum already, based on an initial award in 2019 to make a chip for the European Space Agency. And that chip is now completed. And that chip was for the reception of the signal from a satellite on Earth. That chip has been considered by our peers, and they have voted it the best in class for performance, and the chip is currently being evaluated by terminal providers, and we cautiously hope to have revenues for that chip in the coming year. Recently, EnSilica was awarded a second contract by ESA for £5 million to develop a second chip to work with the first chip in the receiving of signals from satellites in low Earth orbit. We believe we know these chips will work together, and if we can secure the right contracts, we estimate that the market is going to be worth upwards of $1 billion. We know that the supplier to Elon Musk's Starlink, who has a less efficient solution than we do, have already received significant revenues. This is a very significant opportunity for us. So the satellite communication market is set to continue its growth. The Starlink low Earth orbit constellation has demonstrated that there is a demand for satellite-based broadband connectivity. There are opportunities with a number of other satellite operators that we're already talking to, and their chips are suitable for applications including broadband for remote households, automotive, or mass transportation. This might even include having a receiver on the roof of your car so you can pick up satellite communication wherever you are. The lowering of the power requirements of these chips and the terminal costs which our chips address is a key feature of mass market adoption. So in healthcare, we took on a team in 2016 who were specialists in the healthcare sector, and in 2021 we developed a healthcare sensor for the following functions: ECG, heart rate monitoring, blood oxygen level monitoring, body temperature, and amongst many other features, all of which provide healthcare providers with an opportunity for advanced data collection and monitoring using AI. So this could mean a patch on your arm which will connect to your mobile phone, which will send the data to your doctor. It could be a ring on your finger doing the same thing. And we are currently talking to people about how we can develop that. So the key market opportunities for this chip are, as I've just said, glucose monitoring, where the market is estimated to be $16 billion in 2030. Blood pressure monitoring, where the market is considered to be $8 billion by 2030. And a sort of total vital signs monitoring, which includes blood pressure measurement, where the market is considered to be $17 billion by 2030. It also includes smartwatches, fitness trackers, and finally, something is now developing which is called Femtech, applications for female health. The next generation of products needs to have reduction in size, an increase in battery life, lower cost multi-vendor sourcing, so getting all the parts and componentry, and more novel sense interfaces, all of which we think we can address with our current IP. The development will take more investment, but we have the knowledge to do it. And also, I should say, this investment we've made already has come out of existing cash flow. We didn't go and ask for additional funds from anyone to do this development. It's taken us 4 or 5 years, but we are generating cash and we can invest in these things. We have the ability to do that. This slide tries to demonstrate how our business model works. As at the start of when we win a contract, we spend a year, maybe 2 years on designing the chip. That consumes cash. Then it's evaluated, it's tested, and it goes into production, and you get supply revenues. Then your engineers start working on another chip. So gradually, you keep layering these levels of revenue. Your revenue grows quite dramatically, but your base engineering cost stays about the same, although it will grow because we want to get bigger. But so your future cash flows sort of get leveraged by the increase in the number of contracts that you've got. This is the model that some companies have got extremely rich on. I thought I'd give you a bit on our operating performance. So 2021 and 2022 are audited numbers. We took a big loss in 2021. That was the year before we floated. I think Paul was mentioning about the asset limit for VCT growth. So we decided to impair the value of our IP, which created room in the balance sheet for VCT investment. But I can tell you that not to worry about that, because the IP is still very good IP. We're still selling it. We're still making money from it, but it's on the balance sheet for £1. So that describes the large loss. Other than that, this company has never made a loss in 22 years, and that was engineered on purpose. Then in financial 22, we floated at the back end of 22, so that's what we delivered last year. And then 23, obviously, that's just ended, just 15 days ago. This is what the market think. Oh, these three line columns here is what the market think we're going to do. I'm not going to tell you whether we're going to do it or not, but this is what the market thinks. So as you can see, we gradually become more and more cash generative. We pay down our debt over the period. We become net cash by 2025. We're currently net debt. And I'll just highlight someone was talking about EPS numbers. This is what we think the EPS might be. So I can't let this opportunity go without telling you what our investment case is, just in case anyone's forgotten it. Our market we're in a really good place with the market. It's growing very fast. There's lots of inquiry, and it's forecast to grow by 8.3% per annum for the foreseeable future. We can see 35% growth in our revenues over the period 4 or 5 years. We can see that. We don't have the orders for that, but you could tell where it might come from. We have a good pipeline. It's growing. We get huge inquiries. We haven't landed. Well, we'll tell you when we land one, but we've got lots and lots and lots to go for. We think we're good. We're operating well financially. I think we've delivered all our promises that we made at IPO. We've got good operational growth. The model that we've adopted has been adopted by other people. The business model is proven, and we've got an experienced management team. So in summary, thank you again, because it was tough last year getting the IPO away, but we're in a good place. We're well established in good growth markets, and we think we can capitalise on this opportunity. Now, I'll take some questions.
Right, thanks, Mark.
Sorry, I'm still just a little confused as to what you do. I understand you design, develop, but you kept talking about manufacturing. But you don't actually manufacture, do you?
No. I mean, we use what Mark described as the fabless model, fabless semiconductor model. So actually, we do the design, we get the wafers manufactured in Taiwan, Singapore, Germany, and then we manage that process where it goes off to a packaging house, and then we sell the chips to the end customer. So the real revenue flow comes from selling the chips, which often the markets that we're addressing, the revenue from those chips will last 5 to 10 years.
So you effectively source the various components, they come back to you fully assembled, and you sell them on.
That's right. I mean, actually, we never see the chip. I mean, the chip is stored somewhere, and we get the order, and then we ship the we ship the chip. So it's a common model. I mean, companies like Qualcomm, that you would know, MediaTek. I mean, they all use those models. That model.
The value added is the design. Yeah. That's the value add.
Could you describe in more detail how you actually get paid and how your contracts actually work? Is it a royalty basis? Cost of sales? Who bears all that? Yeah. How does that work?
Okay. So there's two parts to the contract. The first part is designing the chip. That's called the NRE, non-recurrable engineering cost. And that's largely funded by the customer. Someone comes along, says we want a custom chip. We quote them for this non-recurring engineering cost. But we also quote them for the supply of the chip, a unit price for the chip, and then it's generally a year to get the first prototype chip, then 18 months to 2 years for it to get into production, and then there's a revenue stream from selling, from selling that chip. And as I said, that revenue stream typically for automotive is 7 years. For industrial, that can be 10 years or more. That's right, yes. I mean, in terms of sourcing it, I mean, generally semiconductor fabless model, works reasonably high gross margins, so 35 to 50% gross margins. And in terms of everyone would during the semiconductor shortage, there was a premium required on sourcing the wafers, and in that case we're able to pass that on to our those additional costs onto our end customer.
If the customer is paying for your engineering cost, then how do you manage to retain the intellectual property right?
Yeah. So we actually have a portfolio of IP we develop and we build on. So the actual chip, if it's a custom chip, that chip will belong to the customer and we will only sell it there. But it's made up of lots of sort of blocks, they're called IP blocks, and those blocks are built on our IP, and they remain our part of our IP, unless they've got some of the customers' particular know-how or ideas in there. So,
but for the engineering cost itself, do you make a return on that as well? So you tell them what it costs to engineer the chip, but do you make some money out of that as well?
Yes, we generally do. Not depend on, it will depend on the case, the type of market, the end volumes. So if there's very large volumes associated with the chip and a good gross margin, there'll be more more competition for the NRE. So there could be cases where, for the right customer, we invest in that ourselves.
Thank you. It's all very exciting. How's the share price doing? Because it looked to me at one stage it went up a heck of a lot, and now it's back down again. How do you square all that?
If I knew the answer to that, I wouldn't be here.
But it's quite dramatic. I mean, it's quite a significant difference, isn't it? It's doubled and it's almost halved again.
Okay, so I mean, the take our broker had on it was that it went down just before April, so people were cashing in on that capital gains tax allowance, because we were, I guess, we performed very well from sort of November, November through to March, and then there was a lot of profit taking from the retail side.
Someone asked a question earlier, which Paul answered, about top slicing. One of our investors top sliced, so that depressed the price. I won't say it was, but it wasn't Amati.
Is there any particular competition from all this open source that you hear about from China and so on?
I mean, you've probably heard that. I mean, the sort of major disruption on the open source side is really a sort of an open source processor, which really affects ARM and the IP providers. So there is something called RISC-V, which is an open source CPU, which is sort of taking on ARM, and that's really the side. But in terms of there are open source tools for helping you develop chips, and some open source source IP, which are actually things we can leverage in some cases to develop chips. So it's really not in competition with us. I mean, they're the sort of basic building blocks of putting together chips. Okay. Thanks very much.
Yeah, if Mark and Ian are staying on, there'll be opportunity to ask more questions, I'm sure, after this. We move on now to our second presentation, and again, I'm delighted to introduce a relatively recent addition to the portfolio, North Coders. North Coders is an IT education, ranging from complete novices to junior engineers, people who want to completely change their career path, they want to reskill, they want to upskill. We're talking here about IT skills that are in huge demand, so the employment record of the graduates from North Coder courses is outstanding, and I'm delighted to have Chris Hull, CEO, to present to you. What do you?
Thank you. Okay, I'll just move those ones. Thank you. Are we just next then? Cool. Okay, hi everyone. I'm going to give you a presentation on North Coders, what we do, and we'll go from there. So, of course, the obligatory disclaimer for anything in this presentation. If you can read that, you're doing very well. I'd just like to introduce the rest of the key board members who aren't here today. There's just myself, who's based in London. We're headquartered up in Manchester. I've got my co-founder and our Chief Partnerships Officer, Amal, our Chief Financial Officer, Charlotte, and I have two non-executive directors, Nick Parker, who's from a financial background, and Angela Williams, who's from a Chief People Officer, corporate background, who sit on our board. So there's 5 of us running the company, and we have a senior leadership team of around 8 people. So we're floated on AIM July 2021. Our ticker is CODE. Amati were one of our cornerstone investors from, well, the very initial idea of going into being a PLC, and support us all the way up to our IPO, cornerstone that investment. And we also raised more investment capital last year, and Amati came back in on that round as well. So I'll just tell you the story of North Coders briefly. We started the company 7 years ago. I'm a career changer myself, and I learnt to code and got a job working for Sky Bet. And at that time, they were recruiting. They had huge recruitment drives. We needed dozens, we needed hundreds of software developers, and we just couldn't get people. I saw myself, as soon as I gained a little bit of experience, that I was in high demand and getting approached. Or, the BBC moved up to Manchester, doubling software developer salaries and so on. And in terms of one of the initiatives we had at Sky was we were bringing in like really smart university graduates, thinking, if we give them the best package and we attract the best people, then they're just going to hit the ground running and go from there. But it just wasn't the case, because the things that you learn in university are actually very different to the technical skills that we use day to day on the ground, because this industry moves incredibly quickly. So we've now got 4 main training hubs, Manchester and Leeds, where most of our team are based. We have Newcastle and Birmingham, and we now have a corporate office just literally over the road here in Moorgate, which is to do with our the B2B side of our business, which I'll talk through now. We believe our business is incredibly simple to understand, so I will run through it with you now. We have 2 main divisions. I'll go into detail on each of those in just a moment. We have training boot camps, and we have business solutions. So we have training for individuals, and then we have services that we supply to corporate businesses. Something's gone wrong with that slide. So we have 3 areas within our training boot camps. We specialise in software development, data engineering, and cloud engineering. I'll come on shortly to our plans for the future and where we intend to go with that. There's something wrong with the colours, unfortunately, on those pages. So a training boot camp is 3 months in length. We have a very vigorous process in terms of selection. It's only around about 6% of people who apply to come on our courses who actually are offered a place, and that's through a vigorous self-selection process. We give people some materials and say, if you want to get onto this course, then you've got to basically make sure that you're ready to learn. That's the only sort of thing that you need to come to North Coders. We've had some people ask, what is a typical North Coder, and there literally is no such thing. We've had someone who was 17, we've had someone almost 70, we've had partners in law firms who just don't want to do the corporate world anymore, and then we've also had a busker. We also had the tannoy announcer for Manchester Piccadilly train station. It literally is, people from here, there, and everywhere who have been part of this community that we've that we've built. And our mission is to help companies close the skills gap whilst creating life-changing opportunities for individuals who come from all walks of life. And then we have the onboarding process where when you're selected, you come on to a 3-month selective training bootcamp. You specialise in either software development, data engineering or cloud engineering. We have various systems that help you to decide which area you're going to specialise in. And then after that, you launch your career in technology. In our early days, we had Oxbridge beating educational outcomes, so we had 97% of people who took our course as a consumer were successful in getting the outcome of earning over the entry-level salary of 26,000 as a software developer. And then the trajectory of those careers has been astronomical. We've got many people now in senior positions 5 years in who are earning double the national average salary, and it really is a very rewarding career for people to get into. So I'll talk about the corporate side of our business. So we supply, we have a hiring partner network. It's actually closer to 500 companies now. We've just put statistics in here, which were from our last audit annual report just in April. And then we also have a corporate division where we have a process whereby engaging with businesses early, we have a model where North Coders hires the top 10% of the people from its courses and deploy them into business on a consultancy basis with wraparound support from more senior people to make sure that when these people who are inexperienced land within your organisation, they have everything that they need to thrive and stay there for the long term. Because ultimately what companies are looking to do is build up that experience level and retain people, and it's a very fast market for people moving on. Recently in our investor roadshow, there was some good feedback from many investors that they really see the scalability in this side of the business. There's a company on the FTSE 250, FDM, who started relatively same size as North Coast, now has a market cap of over 700 million, and they operate globally and they do things slightly differently, but ultimately it's that same model of providing the best entry-level talent to businesses and supporting them to make sure they get the most out of them. We made our first acquisition this year in February. It's a company called Tech Returners, and they specialise at a different end of the market to us. We're more about career changers and people who are new to technology. What Tech Returners do is they take people who have previous experience in the field that have gone off for career breaks. Generally, the reason is having families or moving countries are the two largest reasons for people taking career breaks. But they source people who have over 5 years of experience in as a technologist, and it's not about training them from scratch and teaching them how to code or how to navigate data engineering platforms. It's more about refreshing their skills because things move on so quickly that if you did a certain programming language 5 years ago, it could almost be not even used or unrecognisable in the current market, so that's what they do. And the reason for the acquisition was that we're now much better able to support businesses with blended teams of people. So you've got the entry-level people supported by the returners who are more senior and pick things up quicker, and then we've also got the high-level consultants that look after that entire team for the business. And we also have the largest Women in Technology conference in the north, Reframe, which ran just in March, and we're doing that conference is launching here in London in September as well. I'm going to talk about competition, which we've divided into both the training bootcamp side and the corporate solutions. Within training bootcamps, the usual question is, what about universities, Chris? Everyone's going to obviously choose a university over going to something like a coding bootcamp, but ultimately, and we have had many people that have come from computer science degree backgrounds, and we're not going to sort of stand here and say that the universities aren't fit for purpose, because they do teach some very, very, very good theory and understanding, and it can certainly support you in your career. But what they don't do is they don't change their curriculum fast enough, and they don't work with businesses to really say, what are you using now? And we're always looking for what's next, and then we turn around changes to our curriculum in like 3 weeks, which is a general time between us running various blocks, as opposed to university, which it can be up to 3 years. So that's a major difference with us. Then in terms of coding bootcamps, there is lots and lots of coding bootcamps now. We pride ourselves on our amazing reputation, our best results, and generally the main players in the market are We would say if you're in Scotland, you're probably going to go to CodeClan. If you're in London, you're probably going to go to Makers. And then anything in between is North Coders. Of course, now the model is fairly hybrid, and whilst we have learning hubs, which are a bit like co-working for people to come into an environment where they're better supported, you can take North. We've had students from Hong Kong do North Coders, so it isn't so geographically divided as it used to be. So yeah, within business solutions, there is some big players in our market, but we're going to go on to the size of that in just a moment. FDM, who I've mentioned, are the biggest hire, train, deploy business within our sector. And then with a similar model, you have QA, who they're not public, they're venture capital backed, but they're also a large player in the UK. And Sparta Global are what you would say are a challenger brand to FDM as ourselves. So we have various funding models for our training boot camps, which is basically our engagement and talent pool, which feeds into our corporate solutions to working with businesses to get the ultimate best people. The government's allocated 1.5 billion to skills boot camps, so that is a large funding mechanism now for people to do North Coders, and we really push for that because access to these type of things. Certainly, if we're going to complain about the skills, then the funding for that exists, and it's not an expense. It's £10,000 the course compared to a university fee. It's relatively small. And then the Commission for Employment estimates 1.2 billion new technically enabled people needed by 2022. 2023 now, but this is a huge, vast market, and there's all sorts of different niches, and there's new things coming up all the time. Like, of course, we're looking into now within our data engineering division, people are interested in people to work on AI, which is ultimately machine learning, something that we do anyway. But yeah, we're always moving with the times and adapting to what companies need to stay on top of the game. So we almost doubled our revenue last year. 2021, we were 3 million revenue. We were 5.6 million last year. So we IPO'd at a share price of £1.80. We reached, similar to the previous presentation, we reached peaks of maybe £3.40, and we did recently, actually, after delivering great results, we did have some sellers in our share price, which took it back down a little. But we are still outperforming the market, and we're up on the level that we were at our IPO. So hopefully our shareholders are very happy with that. And then in terms of operational KPIs, we look at the demand for people wanting to join our training bootcamp, and also our bookings within corporate business. So we grow applications, again, almost tripled between those 2 years, and we've recently signed corporate contracts with BAE Systems, Deutsche Bank, and ThoughtWorks, a global tech consultancy, which you may or may not have heard of. But we are really growing in that division also, and we want that to be the big area for the future of the business. So in terms of our EBITDA, we had a loss year in 2020 where, for various reasons, one of the main things was due to COVID, we stopped taking on new customers because we didn't really have much of a clue exactly what was going on in the world, and we wanted to, we're always about the outcomes for the individuals. Our reputation will be the thing that makes us the most successful. So we did stop taking new people. We changed the business model at that point, though, from being, we were literally in person. We had large lecture campuses in Manchester and Leeds. We're almost at the point where we can have a look at our real estate, especially in Manchester, where we have a 10,000 square foot M1 premises, which we likely can significantly downsize to save money on that. And then obviously 2021 came back, and then 2022 we almost tripled our EBITDA along with doubling revenue. And our cash balance is very strong, which I'll go into now what we are doing to invest in the growth. We have covered off currently software development's always been our founding culture. We've done that for years. More recently, 18 months ago, we added data engineering due to the demand in the market, which is also getting bigger now due to the pushes in AI. Cloud engineering, I'm sure everyone's heard, everyone is, migration to the cloud is a very big thing for businesses. There's probably less cloud engineers to the amount of data engineers and software engineers because you just need less people to run that infrastructure. The next investment for us is to go into cybersecurity, which is an absolutely huge market, and we are putting the foundation in place this year for that. with an idea of launching into that sector next year. And then there's also some smaller areas, niche areas that will support our corporate business in terms of project management and so on. Yes, so far this year we're well up on our applications. We're trading in line with our expectations for this year. We have got repeat contracts signed. Rolls-Royce is our biggest client, Corporate Solutions, who signed a repeat contract. It's relatively new. The products within our solutions division, we used to be very consultative. We would basically charge time and materials to businesses to support them. Now we have packaged products which are much easier to sell, and we're investing in our business development team, corporate office here in London. And then we also have strengthened that with tech returners, which is a truly unique offering in our market. That's it from me. There you go, 14 minutes. Didn't do too bad. Thank you. So yeah, that does say any questions, but it's a nice picture. So there we go. Thank you.
Thank you very much. That was very interesting indeed. Can I just ask you about the challenge that seems to be coming your way from the de-skilling of the coding software programming skills through to AI chatbots? I'm told it is remarkable the impact that has in the programming sector. Please.
Was the question, is AI eating our lunch?
Yes, I suppose it was, yes.
Cool. So AI, the way that we embrace and we work with AI to show people how they can use that to strengthen their skill set. But you're right, you can, AI can now, in terms of like programming languages, there's lots of specific different types of technology. There is AI tools in software development that help you to develop things in different programming languages much faster and easier than you could do before. But in terms of our area of growth is making the value of each of our seats, which is one of our key metrics, how many people start our training boot camps, significantly more revenue through our corporate solutions division. So it's not a case of us thinking, cool, we've got 1,000 North Coders this year. We need 10,000, 100,000, 500,000 to grow this business. We're being much more strategic than that. And within AI itself, there's a lot of engineering opportunity. There's lots of companies who are hiring people to build AI solutions and things. And within our data engineering division, we're making those changes so that we are. That's an opportunity for us as opposed to a huge threat. However, yeah, it is simplifying some of the roles of software developers, but the fact of the matter is that we still need millions of technologists in the time that we're going to be here to deliver on that. Yeah, but it's a common question. Cool. Gentleman in the back.
Just want to be clear in my mind. What is your range of revenue stream? Is it the, using the generic word, training of people or retraining, or is it the ongoing commitment of those people coming out of the program to a particular business?
So the majority of our revenue currently at the levels that we're at is generated by the training boot camps, around about 80% of that. It is going to be lower percentage-wise, whilst the revenue should grow to around 10 million in the forecasts from the brokers this year. That will be a higher percentage of that will be corporate business, and our aim is to continue to have our training boot camps is our heritage, but from that we are engaging with more businesses to make each of those seats within our training boot camp division worth a lot more revenue through the corporate solutions. So our plan is, driving the business forward, is that will be the area of growth. But the training boot camps, we do grow them. We have the intakes are getting larger towards the end of this year, but for us it's not about people saying, oh, why don't you just do 5,000 people a month, Chris? But that is going to be giving us more of we want to make sure we get the best people, and that's where we're really going to win in the world, as opposed to just having lots and lots and lots of these individuals.
Thank you for that.
No problem. Thank you.
So to what extent are the products of your training process, particularly into the corporate business, how do you keep those individuals within your billing mechanism, if I can use that? In other words, how do you keep them integral to your product
and stop them moving away?
Yeah, very good question. So one of our main differentiators is that we empower people to thrive by giving them future opportunity and more cross-skilling. Whereas, within our competition, there is like training agreements. You can go along and you can join one of our competitors, and if you want to, then you're held down to, if you leave, you've got to pay them 50 grand for your training. But all that's doing for the business is having individuals that it's always about, within our consultancy division, the investment is in these people in 2, 5, 10 years belonging to the organisation. Like with Rolls-Royce, at the end of their contract, the people, they're free to hire them. We're building an ecosystem with these companies. And the best way to do it is, I think through trust, not fear is probably a good way to answer that. We don't lock people into training agreements, and that is something that goes down very well with our companies. And we probably do lose the odd person, which that isn't ideal for us. But it's a low percentage compared to the amount of people unsupported within industry that go in as a junior. 9 months later, people are being offered 50% hike in their salaries, and we of course keep up with as people continue through their careers. The salaries increase in line with the market, but we're just all about empowering people to love the organisation that they're embedded in, as opposed to, I can't wait to get out of this training agreement so I can actually go and earn some more money.
This body, this person's gone through, joined Rolls-Royce, made a success of it. Are they an employee of Rolls-Royce or an employee of North Coders?
They're employed on the payroll by North Coders. There is a contractor rate with Rolls-Royce. At the end, that's for anyone who is coming from any of our training frameworks, tech returners and North Coders. However, we have senior level consultants, team leaders that are there to ensure that the organisation doesn't feel the strain of having a mass input of new individuals. If they're not looked after, they're going to leave. So we're there to help them stay. At the end of the contract, they vary in length, but generally 18 months. The Rolls-Royce can hire those people with no charge, because we've made the profit throughout the contract. And Rolls-Royce did hire them all, and none of them had left. And then they renewed again with a larger contract.
If there aren't any more questions, and I think thank you very much.
Okay, no problem. Thank you.
Good afternoon. I'm told there's no need for introduction, so we can just jump straight in. I'm Michael Zverim. I'm a co-manager of the Strategic Innovation Fund, one of the newer funds we launched at Amati.
Yeah, I'm Graham Benke, and I'm co-manage the fund with Mikhail.
So we'll do a double act. We'll give you hopefully a 15-minute introduction to what we're doing with the fund, how it came about, and there'll be some time for questions. So there we are. To be Amati Strategic Innovation Fund, we launched in May last year, so we just turned 1. Which means, according to FCA rules, we can talk about our performance. Of course, there's a disclaimer, but you're familiar with that. It's very legible, I'm sure, from the back. So what are we trying to do? We're investing in pioneers, enablers, and adopters of innovation. What does it mean? We're investing in companies and businesses that stand to benefit from innovation, that create value from innovation in a variety of ways, and where this value is not priced in by the market. Why we're doing this, why we're focusing on this, what is different in how we're pursuing this? Well, first thing to say, innovation creates a lot of value. We'll talk about this in more detail. Innovation creates a lot of value in more places. We're finding more places to innovate, more industries where innovation makes a difference. Our demand for innovative solutions in all walks of life, as societies, as business and consumers, is increasing. But equally importantly, innovation is complex, it's uncertain, it's multidisciplinary. Investors are not always well equipped to understand the impact of innovation. So it's a fantastic opportunity set for an active stock picker, and that's what we are. We're somewhat different in how we approach investing in innovation. We like this complexity. We go deep into the technical detail. We like kind of what we call the undergrowth. Companies that are doing something technical, something complex, requires a bit of effort to understand, because that's where undiscovered high conviction ideas come from. But at the same time, we take a broader approach. We're not just interested in, dare I say, concept stocks and exciting but potentially unproven high-risk businesses. We're interested in picks and shovels suppliers that serve those as well, and we're interested in lateral beneficiaries of this innovation. And we find sometimes the best deal, the optimal risk-reward, is not in the famous pioneer, it's an enabler or an adopter, as we call them. And we're very focused on profitability and cash generation. That wasn't a popular approach to innovation 2 years ago, but I think the past 2 years had reminded us, rather than proven to us, reminded us why this is important. We think we built a team that has the right experience, the right track record, and the right skill sets to tackle that opportunity set. But we're very excited to be doing this at Amati for a number of reasons, which we'll get to in a moment. Amati is a great platform, a very informationally advantaged platform to build this product on.
Yeah, just a quick couple of words about the fund itself, the structure. It's quite a concentrated portfolio. We can hold between 30 and 40 stocks. We have about 30. We have 35 holdings at the moment. It's a properly global fund, so we can go anywhere theoretically, geographically, and market cap-wise. So our approach is to, because we sort of aim to get into a little bit more into the weeds, if you like. We tend to hold what we call mid-cap stocks. So you can see about 39 billion on average is our average market cap for the fund, which is quite different from the small cap you talk about in the VCT, but also very different from our benchmark, which is the MSCI All Countries World, where the average market cap is actually over 350 billion. So we've invested in sort of relatively smaller companies compared to that. Very importantly, we are, unlike a lot of innovation funds, we're very careful about or interested in valuation of the stocks we buy. So the companies we buy are real businesses that are generating real cash flow and have a proper earnings multiple. So our earnings multiple on average for the fund is not dissimilar to the benchmark, which is quite different from a lot of other innovation funds you'll come across.
We're a team of 3. You may know Gareth Blades, who also helps with the smaller companies and the VCT. We joined just over a year ago. Both Graham and I ran high conviction global funds and some of the largest fund management companies in the world. I headed up global equities team at Standard Life Investments, and then at Aviva Investors. Graham did this at PineBridge, which used to be called AIG Investment Management. We ran multi-billion franchises in our time and achieved multi-year top quartile performance. So we've taken the best learnings from a fairly long career in global equities and designed a product that takes the best of that work, particularly suited to what we can do at Amati, and designed this product. We invested in this product ourselves. We seeded this fund with our capital as well as with capital of some of our Amati colleagues. So we build a product that we think plays to our strengths and we love to own ourselves in the long run. We invest in complex technical subjects. It's important to have a degree of awareness and skill set of those subjects. We have between us a semiconductor physics, aviation, biotech background. We didn't just watch the Bloomberg terminals all our lives. We spent time raising money for technology companies, advising high growth companies, engineering companies, commercializing university IP. So we got our hands dirty as much as you can do in the kind of fairly clean innovation space, not nearly as dirty as Mark and George got in actual mines, but we did a bit on the front line. But we also have a degree of background of accounting, finance, business, because we remember, and sometimes investors forgot, but they've been reminded again, that innovation investing isn't about science projects. It's about businesses that create shareholder value, and you need to see profitability, cash generation, return on capital employed as a result of this work. We're doing this at Amati not completely by coincidence. Both of us started our buy-side careers in the smaller companies world. Graham worked in FNC. I actually started my career with Paul, working for 5 years on First State Smaller Companies Fund and what then was called First State AMVCT. So I'm here as a very long-term VCT shareholder since 2005. And we remember the time when ARM Holdings was a small company. We've met small companies who told us about biologics revolution and drug discovery long before it happened. We met companies that explained to us that GPUs or highly parallelized processing is the key to machine learning and AI long before it happened. And we industrialized that process here. We learn a lot from some of the executives you met earlier with whom we have as a firm really deep, high quality connections, technical experts, entrepreneurs behind those companies, often at the forefront of technological change in their industries. we understand better, talking to them, what's happening at the leading edge of our industry. So we take those learnings globally, and we hope we'll pick global winners better than other global investors might.
This slide, just to give you a few examples of some of the innovation frontiers that we're invested in and we like and we think are interesting for the next sort of 3 to 5 years, which is our investment horizon. You'll be aware of most of these, I imagine, and if you're interested, reports of these are available on our website, so please do go and have a look. But gene sequencing, I imagine a lot of you know that gene sequencing costs have come down dramatically over the last decade or so, and that's opening up new markets and new tools and services that are coming from that technology innovation. And it's an area we think is really interesting for investing in a couple of niches, and we will talk about that in a little bit more detail. EVs, obviously, again, a really interesting one. We're trying to find companies that will win in that battle regardless of which OEMs or which car manufacturers win, if you like. So the suppliers, the enablers of the innovation. Machine vision, again, is another really interesting one where it's not a new technology, but lots of things have come together now to make machine vision a really strong growth area for the next decade. You know, things like robotics, 5G, and just improvements in costs of silicon have meant that machine vision is really taking off in areas like drones and warehouse automation and lots of other areas. So again, lots of interesting things to look at.
I've just been reminded by Graham that we do have this material on our website, but we also have a QR code in your packs. And if this presentation isn't very legible on the screen, you can get a copy of it through the QR code on your pack, and I think lots of other materials through that link. We talk about our kind of more pragmatic, more valuation-aware approach. I think it makes a lot of difference. We have a long-term view on innovation. We look 3 to 5 years out, but we're not futurists. We have this mantra, which is actually a quote from a science fiction writer, maybe inappropriately. The future is already here, it's just not evenly distributed. We're looking for innovation that's already made a difference, that's already changing the industry, that's already making money, and it just haven't proliferated as widely as it will over time. We're not imagining the world in 10 years' time and kind of working backwards from that. It's a low turnover, fundamental bottom-up approach. We have a broader view on innovation. We like what we call pioneers, the inventors, if you like, the leading edge. But we know that some of those will be high risk, maybe high reward, but high risk, unproven businesses. Even the product in those companies may sometimes not be proven out yet, never mind the business model. So we're conscious of that risk. So we follow the thread of that innovation further into the value chain, and we see, well, who supplies them with ingredients, with equipment, with support services, the picks and shovels, if you like. And who will be the lateral beneficiaries? Who have a real estate, if you like, a client base, an installed base of equipment, that if you add that innovation to the mix, will become a more valuable business. We call them pioneers, enablers, and adopters. And we can't emphasize enough, we think about innovation at the right price. We have valuation discipline. We want our companies to be profitable, or at least have a clear roadmap to profitability in the fairly near term. We want them to be cash generative. We want their dream to be self-funding, not dependent on continuous generosity of capital markets, which, as we know, can ebb and flow. So to give you an example of what this means, at the beginning of our fund's life, we were very interested in gaining exposure in all this revolution in advanced testing and diagnostics, in resulting from sort of improved genomics technologies. And the clear pioneer in that space is Illumina. Some of this reduction in cost of gene sequencing, Illumina machines is what drives that. They are a brilliant company, little known, but the technology behind it has been invented in the UK. Illumina bought it for relatively little money more than a decade ago and made it into a multi-billion global business. Now, Illumina at the time was trading at 47 times earnings. It generated some cash, but the free cash flow yield was just over 1%. It was pretty well discovered, a 40 billion market cap company at the forefront of any investor who was thinking about genomics at the time. But then we thought, okay, let's follow that logic further. The genetics discoveries that are made on Illumina machines, the connection between the expression of the gene and the propensity to develop the disease, the progression of the disease, the best way to treat that disease, gets productized, gets commercialized not a multi-million-dollar, multiple PhD stuffed academic-grade Illumina machine, but in what we now know very well, PCR testers. PCR is a genetic test that already knows what you're looking for. High throughput, efficient clinical machine. And the leading maker of high throughput digital PCR machine is QIAGEN. So all this avalanche of genetic discoveries discovered on Illumina machines end up becoming tests on the menu for QIAGEN machines. And one of the results of COVID is that the installed base of these machines has exploded. And we didn't think that was in the price. Moreover, these tests will be performed in networks of labs at the central logistic network of sample collection, preparation, and shipment, and the information kind of related to returns of those results. And there are relatively few companies that dominate that kind of industrial scale lab space, and one of them is LabCorp, which is an American company. Again, looking at PEs, instead of almost 50, you get 21 times and 14 times for companies that are still growing and still benefiting from that innovation. So that's an example of how broadening that outlook, broadening that range of options can help you find a more optimal risk reward. We're doing this at Amati, and I mentioned that earlier that connecting the dots between what's happening in the VCT and in the small cap space and the bigger mid cap, large cap space can be really valuable. This is an image of an Intuitive Surgical ion machine. Intuitive Surgical is a leader in robotic surgery equipment. I'm cognizant that we're doing this at the surgeon's barber's hall, from the days when the person who shaved your beard is also the person who performed your surgery operation. The technology moved over a fair bit since then. So Intuitive is the leader in that robotic surgery machines, but they need instruments at the end of their robotic arms. And Creo Medical, which is a VCT holding, is a developer of one of those potentially revolutionary robotic arms for pulmonary surgery. So we can bring our global perspective, understanding Intuitive Surgical, researching that big company, to bear on understanding where Creo Medical fits in. And through a conversation with Creo Medical, we can understand more about Intuitive Surgical business than most of my global equity colleagues would just listening to the management of Intuitive Surgical themselves. So this is a really interesting and valuable angle. It can go further than that. We have a holding in VCT in a company called Chorus Intelligence, which is a category leader in police intelligence software in the UK. Now, in our global portfolio, in our strategic innovation portfolio, we own Motorola Solutions. And if you look at the sort of technological infrastructure of the modern law enforcement, you see command and control centers, the video surveillance equipment and software that processes those video feeds. You see police radios, you see kind of mobile computing. These companies that we speak with, and one of which we have shareholders in, have really good perspective on that. But through Chorus, we can get more. I've spoken to a member of the advisory board who is a former deputy head of New Jersey Police Department, who is now advising US police departments on adoption of technology. That's a really interesting angle for an investor pursuing these companies as well. And in return, we introduced a Chorus Intelligence team to the corporate venturing teams in those companies. So as and when they're looking for a stronger US distribution partner, or maybe even source of funds for the next round, we hope we can be useful to them as a shareholder in this way. Graham mentioned some of the innovation frontiers we're pursuing, these areas of interesting innovation where we think a lot of change is happening and a lot of opportunities arise. The next couple of slides give you a glimpse of what we're looking for. For example, we're really interested in photonics. That's not something you hear from a lot of global managers, but we see a lot of change in telecom and datacom space. Copper isn't enough anymore to transport the bandwidth of data that we need, the quantity of data that we need, at the speed, latency, and performance that we require. So just as your copper wire for your home broadband got replaced by a fiber to the curb or maybe a fiber to the home, that's happening in enterprise networks, that's happening in data centers. It creates really interesting opportunities for companies that supply bits and pieces, lasers, passive optical components into that space. And not only that, 3D sensing, enabling some of that machine vision, and even materials processing often uses the same lasers and optical components as well.
So I'm aware we want to try and get some questions, time for questions, so I'll be relatively swift. But there are a few more on the next couple of slides, a few more of the frontiers. And very briefly, industrial design tools is a really interesting area where there's a lot of change and innovation going on. It in itself is a really interesting area, but they're using things like augmented reality and virtual reality to help engineers and technicians to make their jobs easier and more straightforward. So that technology, that virtual reality technology, is starting to actually really impact this space where it isn't in the consumer market, but really is coming of age there. To give you another example, this company, AutoStore, it's a relatively small Norwegian company, but it's dominating the high-density cube storage warehouse automation market, growing incredibly fast, and again, cash generative, very reasonable multiple if you sort of look out a couple of years, given the growth. And these are the type of sort of niche companies we're looking to find that benefit from the innovation frontiers we're talking about. And I won't go into any more detail on that one. But just to wrap up, the portfolio, it's obviously very concentrated. We're very different from the benchmark. So we have a 97% active share. I'm happy to explain that afterwards if you like, if anyone is not familiar with that term. But things you will be familiar with, PE ratio, we're very similar to the benchmark. Again, very unusual in relation to other sort of technology-based or innovation-based portfolios you'll come across. We get that multiple despite also offering higher earnings growth. And again, we can talk about that in a bit more detail if you want. And buying companies that generate free cash. Generate free cash and have strong balance sheets. So low net debt to EBITDA. So these are companies that, regardless of what happens with the sort of broader economy and financial markets, they're not dependent on coming back to get equity capital or raise additional debt from the financial markets. These are self-sustaining, cash-generative businesses. And that's what we look for, and that's what we like. Mikhail mentioned we have quite a lot of our own money in this fund, and for the long run, we like the comfort of having companies that are self-sustaining, self-funding, and where we're not paying unreasonable multiples for the growth. I think that's...
Yeah, that's us in a nutshell. We think we know we're very different from the benchmark because our active share that measures that shows that. We're very different from just buying the market index. We're also very different from the biggest global funds you can think of, Fundsmith, Lindsell Train, Rathbone Global Opportunity. Our overlap with these funds is one or two names and a couple of % of value. And we're quite different from the kind of the iconic, if you like, innovation funds like Arc Innovation or Scottish Mortgage, where again our overlap with those is a couple of names and a couple of percentage points of value. So we felt it's quite a differentiated approach to look for innovation, and it's certainly something we're very happy to own in the long run. So I'll stop here, and we should have time for Q&A, and the microphone's in the room. So I was told that we better wait for the microphone to arrive, or else the live streaming audience would not hear anything.
Thank you. Can you explain why you launched as a fund rather than an investment trust?
Well, it's a very liquid portfolio. Our weighted average market cap is 35 billion. Now, we have smaller companies. We have companies 1, 2, 3 billion market cap. But we're very liquid. We have no liquidity constraints, and therefore we don't have to have an investment trust structure around it. We can be open-ended. There's a question behind you.
Sorry, maybe because I can't read it, but what is the benchmark? What are you measuring yourself against?
We ask our clients to compare us to MSCI ACWI, which is the kind of a generic everything in the market benchmark. We're very different from it. We only have 3% of our value in common with that benchmark. So, we all come from institutional backgrounds where investors are very alert of benchmark. We always had a view that benchmark reflects consensus. The companies that are big in the benchmark are big because they already happened. We want to find something that hasn't been yet reflected by the consensus thinking. But we're cognizant of the fact that we're a global fund, and the obvious and cheap alternative for our investors is to invest in the global index, which tend to be MSCI ACWI. So over time, over 3 to 5 year time horizon, we should do meaningfully better than that, or else we're not doing our job. There's a question in front.
Your fund size is quite small and your fees are quite modest. Is that a sustainable model?
Well, yeah, it's a very early days for us, obviously. As Mikhail said, we just had our 1-year anniversary a couple of days ago. So this was self-funded, self-seeded by Amati, the team and other people at Amati, basically. And we're in this for the long run, and we're happy to grow. And actually, Amati has some experience here in that I think the UK Smaller Companies Fund had a similar kind of early stage and then improving trajectory. So we're looking to kind of follow that roadmap, if you like.
Yeah, I used to, when I took over Standard Life Investments Global Unconstrained Fund in 2010, it was 12 million, admittedly a bit bigger than our 6, but we're talking about a FTSE 100 company. By the time I left, it was that strategy was over $1 billion in AUM. So we're happy to wait.
To turn it around the other way, at what size would you find it was difficult to manage with the resources you've got?
Yeah, I mean, the average liquidity of the holdings is sort of mid-30s billion or so, and that'll move around a little bit, but it'll always be around that level. So very liquid. So I mean, the fund could support several billion of AUM without any problem, liquidity-wise. And as far as team resources go, whether we run 6 million or 1.5 billion, we're going to be buying the same companies, doing the same research, and we have very low turnover. So we're not looking to find lots of ideas constantly. We're looking to find a few really interesting, great ideas for the long run. So we don't need a big team for that.
I mean, one thing we promise is that we will be very transparent in where we make money. And there's a way you can do it. You can attribute your performance to market cap scales. And if you crunch those numbers and in 2 years' time it turns out that all the money we've made was on the very low end of the market cap scale, then we will make a judgment call and say, okay, maybe we should close early. But hopefully we can find ideas across the board. I mean, the smallest company we ever bought was 500 million, which was a military radar manufacturer, which was acquired and done really well. The largest company we bought was 500 billion, and that was NVIDIA at the beginning of this year. So we think there's opportunity across the board. The gentleman just behind you.
What's your national mix at the moment?
We got 57% in the US, a couple of percent in Asia, which is mostly exclusively South Korea, 20-something% in continental Europe, a couple percent in the UK. It's completely a consequence of the bottom up. US is a big source of innovation and innovative companies, but it's not the only source. We have 2 Norwegian companies, bizarrely, which we think are at the leading edge of what they do, the warehouse automation and low power connectivity semiconductors. There's a question right at the back.
Thank you. A two-part question, if I may. Was the stock price increase in NVIDIA a surprise to you? And part two, if NVIDIA had never happened, how would the portfolio performance have been after 12 months?
So we bought NVIDIA expecting it to perform. We had a 3 to 5 year investment case that it'll double, and it did that in a couple of months. So the price increase wasn't a surprise. We thought this would happen over time. The pace and the kind of the exuberance around it was a surprise. It helped us to keep up somewhat with the market, but not completely, because somebody asked a question earlier about this big tech rally, which really was several companies. We worry about that. Some of that feels too thematic and wholesale and doesn't really reflect underlying fundamentals. We're not convinced, for example, that generative AI is good news for Google. There is a very plausible scenario that's horrible news for Google, because rather than searching for things and being presented lots of links, some of which make them a lot of money, you just get a page answer and you go away. And Google, you can build a model credibly that Google meaningfully loses its advertising inventory, but substantially increases its costs. And he added $500 billion in value over the past 6 months. So we don't think that wholesale FANG rally is completely rational, but such as the market. I think we're out of time. So thank you very much for your interest, and I'll pass it on to the next team.
Hopefully we can see with the sun. Thank you very much, and thank you for staying for the twilight session. And today I want to really present the theme about the Metals Fund. I'm going to switch things up a bit. What I'd like to present is the investment opportunity in the theme. If you like that, you can hear about the fund at the end of the presentation. We're 2 years old, just over 2 years old, launched from inception, again seeded with Amati and friends and family, and the fund now is just under £90 million. This is going to indemnify me from anything I say, so if there are any forward-looking statements, I've used credible data and thought with my projections, but this covers me. The slide here, you can see, is really about why did we want to launch a strategic metals fund. And what we came up with from inception is there wasn't a fund in the UK that had the same style of investment, management approach, and technical understanding of mines. And what the strategic metal fund is really looking at is the managers, myself and my colleague George Lakeem, we invest in development risk in the natural resource sector. And to do that, you need technical expertise, not only in financial discipline and analysis, but also industry. I'm a geologist by background. My colleague George is a mining engineer. So with these skills, dual expertise, we can then invest in this development risk. And what you'll find is that the market is very reticent in investing in development risk until the mine is in production. We invest in development. By the time it gets to production, in theory and proven in practice, we've already made 20, 30, 40, 50% return on that stock before it goes into being valued like a free cash flow multiple. The other theme and reason for the fund, and this is quite fundamental to the core of this investment, is if you can't grow it, you need to mine it. And the theme of decarbonisation of the global energy supply and a renewable energy rollout needs metal. There's no other way around it. With that massive demand, massive demand, what we've seen, and this is an interesting point, is my industry has been really poorly capitalized to respond to this demand. And you want to be invested in sectors that are supply-driven and not demand-driven. And this is a case in point for the metals market, that we've had 15 years of underinvestment in the mining sector. And I'll show you some slides later. What that means is, but if we look at the next 5 to 10 to 15 years, the demand side of that equation has never been stronger. So this is the opportunity where you get a supply squeeze and metal prices will be higher for longer. And that's the principal reason for looking at this fund. Those two issues, what happens there is you get M&A. So the mid-cap and large-cap mining space, they're not deploying capital into the ground to explore or develop assets. They rely on the juniors to find them, and then they get acquired. So that's the third leg to our stool here, is that we've got an M&A style in the fund. On top of that, so that's your critical metals, your battery metals bookend. The other side of the fund, and this is unique for this fund in the UK, I said it's the only one of its style, is that we've got a precious metal optionality or investment the other side. So geopolitical risk and QE, that has to be paid for sometime. And what we've done in the fund here is, at the moment, half of that fund is invested in precious metals. On top of that, given our technical abilities, we see a lot of investment opportunities in the resource space. And I'm not reliant on a higher commodity price to make money on my investments. I just got to look for companies that find discoveries or de-risk that asset into a mine. George, he's not here today, unfortunately. He's in Canada looking at a graphite and lithium mine. But you can see he's got a wealth of experience. We've both worked together for 20-odd years. He's got 29 years in the fund management and investment banking sector, mining engineer by background in gold and coal in South Africa. Myself, 21 years of experience, 5 working as exploration geologist in gold throughout Africa, and I've done a mineral project appraisal. So this is the technical due diligence that we bring to this fund, a very actively managed fund. This is to prove that we actually do get on site, and coined the phrase, it's Amati boots on the ground. These are all the recent site visits that we've been on in the last 2 years, and this is our differentiator for this fund. The fund managers get on site, they do their due diligence, and they look for opportunity that the market's too lazy to look for or go on site. Not many fund managers do this. And as Graham and Mikhail put out on our website, we've got a lot of our reports here. These are the Amati site visit series, going from Germany through to Tanzania, through to Brazil and Guyana, recent trip. This is our performance. The actual benchmark to the fund is the Globe EMEX, but there isn't a fund benchmark that actually encapsulates the fact that we do precious metals and critical metals. So what we've tried to do here is use 2 proxy benchmarks. One is the junior Vanek gold miners, and that's in the black here. So that's your index of 90 odd small junior gold stocks, and we've managed to outperform that quite nicely, even though we've got half of our fund in gold. And the other is the TSX Global Base Metal Fund. So we've actually managed to match the performance of a 100% battery metal base metal fund through only having half exposure in our fund, and we've done that through stock picking. Yet we've maintained the optionality and geopolitical risk that we're all aware of. So you've got this, and we could argue that you're not actually losing performance, but you've got the comfort of a re-rate in the gold sector, which I'll show you later on is quite compelling. This is Sprott's analysis, and what it's saying is that decarbonisation needs metal mining and exploration. And these are all the metals in all the different applications for renewables that we can invest in, and pretty much we've invested in all of those. A recent entrant and investment is into the nuclear power, so we've got 6% of the fund in nuclear power, and that's done very well for us. But you can see we're kind of sport for choice in terms of what we invest in. It's a concentrated fund of 40 to 45 names, and it's invested through the suite of these metals. Now, this is the demand side of things, and it's played out in effectively in a supply response, i.e. number of mines or battery manufacturers or electric vehicle assembly plants needed to meet the stated policy scenario or the announced APS, which is the announced pledge scenario. So these were the government pledges in the COP 27-28 that they agreed to get to a 1.5 to 2 degree pathway, but also to a net zero. What's compelling here, and I'm the mining investor, I'm just looking at the left-hand side of this chart. I'm just investing in the resource space, not in the EVs and battery cells. If we get even to a conservative scenario of meeting our global temperature pledges, we need 30 new mines pretty much in the next 8 years. In lithium, for example. We need 40 in nickel as a conservative scenario. Cobalt, 11. What I'll show you next is how long it takes to actually commercialize a discovery into a mine, and it's more than 10 years. So there's an opportunity here that I see as a material supply squeeze on the market, and you can invest in that through our fund. This is a chart on the left is the average time from discovery inception to production, development and production. For lithium mine, it's about 10 to 12 years. A nickel mine, a little bit longer. We're looking at 15 because it's usually an underground development. But you can see the easy part of the equation is actually the assembly plants for the anode, the cathode, the battery, the assembly, and the EV. So if it takes 15 years really to bring a mine on stream, another example I found was analysis of 127 mines in gold, base metals, and all mines studied, including zinc. You can see the average time from construction, discovery, exploration, construction, and startup is about 15 to 16 years, regardless of the commodity you're investing in. So what that points to, again, is a supply squeeze. I'm going to make money by investing in this pink line. That's the raw materials. And you can see since 2018, we've had $250 billion sunk into EV plants. We've had about 110 billion in the battery fabrication plants in Korea and North America and China. But we've had only $45 billion invested and sunk into the mines to provide feedstock for these industries. So that's why I'm invested in the resource space. Just to highlight the supply response or the lack of it in my industry, this is a chart on the left, capital development. So that's the sunk capital put into all mines, excluding ferrous iron ore mines around the world. And you can see that my industry peaked in 2011, 2012. And that was when the market was awash with cash. Investors were giving companies equity raises, really saying, I want growth over margin. And what happened is a lot of the mines from all commodities were brought on stream and they oversupplied. These mines shouldn't have been brought on with the prices they did. What's happened is it's taken 10 to 15 years to really sort out the metal markets, but more importantly, for these companies to recapitalize their balance sheets. They're in a terrible position, and we're at the point now, even if you look at development, or on this side, this is discoveries by commodity, same thing, 2011, 2012, it peaked. Number of commodities and discoveries made is woefully low. Yet the demand curve coming is woefully high. Looking at this other way, we've got this culture now that the mining companies, driven by the investors because they got burnt in the last cycle, saying, I want dividends, I don't want development. I'd rather have my money back. And if you look at the non-ferrous exploration budgets, again, the peak was in 2010, 2012. We've had a slowdown. We're just starting to have a little bit of an uptick. But what's interesting, if you break down that number of exploration budgets, we've got just over 2,100. Who's actually contributing to that development? It's the juniors. On this bottom chart here, you've got the juniors' share of global exploration at 11-year high. So even though you've got the Rio Tintos, the BHPs of the world, it's the juniors that are doing the heavy lifting to find new ounces or new metal deposits. And that's why the Amati fund is invested in the junior and mid-cap space. The copper, this is an analysis of a copper industry. Obviously, we've had a peak in copper. It went over $4.50. Goldman Sachs were saying it was going to go over $5. This is the EBITDA that these copper companies, this is industry-wide. It's over $110 billion of EBITDA from the group in the last 2 years, effectively. But just look at the woeful redeployment of capital. These are the new mines that are being brought on stream. There's only 2 this year, yet they've made over $110 billion of capital. Again, this points to a supply squeeze in my industry. The other side of the bookmark is the precious metals in the fund. Similarly, we've got this very strange position at the moment where gold is nearly at an all-time high, yet the actual equities that are pricing in are 20-25% discount to the current metal price. The investors' appetite for gold investment is just not there. We're value investors in this fund, and we look for opportunity through growth through the drill bit and discovery and development. That's why we've got half the fund in the precious metal space. It's such an unloved sector. If you look at the enterprise value per resource ounce divided by the gold price, what that's basically saying is how expensive are these companies if you value the inventory of ounces they have on the balance sheet. Pretty much at nearly an all-time low. So this is the reasons why you want to be investing in these sectors. It's a very, very complicated or busy slide, and I encourage you to take it away and actually read it in detail. But what I'm trying to do here is give you an idea graphically of what the philosophy of the Strategic Metal Fund is. This is called the Lassonde discovery or metal chart. And Pierre Lassonde was a North Canadian mining veteran and a very successful investor. And what he tried to do graphically was say, what is the lifestyle of an investment? You usually get discovery. It takes 5-6 years to find a discovery. And then you get the market excitement about that drill bit discovery. Generally what happens if you're not on top of your investments is the market gets overexcited about the discovery and overvalues a company. So then the company has to pay catch up to the market cap, and that's a worrying scenario. Then when you get the times 2 to 3 to 5 years where they're developing out this ore body, that's where there's not a lot of news, not a lot of excitement, the market gets bored and they start selling off the asset. But actually, they're actually de-risking the asset, yet the market doesn't care about that. So here you can see we've got 49% of the portfolio in the developers, and we've got 39% in the producers. And that's quite an easy, more of a beta than anything else, investment where I can analyze the companies just based on free cash flow and metal price projections. But you can see how I'm trying to construct this portfolio to get optionality through de-risking of development. We've got 11% in the explorers, and as a geologist, I'm knowing when the market overpays for expectation of discovery. Just a little bit about the fund, if that interests you, about the thematics. This is the risk management. Investing in natural resources is a very complicated and difficult industry to invest in. So what we try to do is we manage risk in the portfolio through asset split, type of investment, jurisdiction, geographical exposure. And you can see here we've got about just under half in the gold and silver space. 45% is in the specialty. So that's your graphite, your lithium, your vanadium, your rare earths, all needed for global decarbonisation. We've got a little bit of industrial, and that's by proxy of the fact that gold mines usually have copper with them. So we've got a little bit of copper, and then probably 5% of that industrial is actually nickel mines in Australia and one in Brazil. So we're trying to tap the high-grade deposits for that nickel, manganese, cobalt battery. And we've got only a little bit of cash here. It's 4%, but we try and keep it below 3%. But sources of liquidity as well. We've got some large cap gold stocks which I can sell if I need to get a cash requirement. Other side of managing risk is obviously geographical exposure. And we do that by, we've got a top-down HESG policy at Amati, where we use the Freedom House guidelines, where if a country is not free and fair, regardless of the quality of the ESG ethics of that company in that country, I don't want to invest for a company that's providing royalties and tax dollars to prop up a corrupt government. So by that, we don't invest in the former Soviet Union, Russia, China, South Africa, because they're still killing people on the underground mines. In Africa, Greater Chad, Eritrea, Ethiopia. We won't invest in Venezuela or Bolivia, to give you an example of the countries that we don't. But there's enough opportunities to invest in, mainly because we've got a concentrated portfolio of only 40 to 45 names. On the market cap side of things, we manage risk. For us in our industry, $1 billion to $2 billion is actually a good-sized mining development company. It's not a super major like the Rio Tinto or the BHP, but this is our sweet spot, really 250 to 2 billion. Reason being because we can deploy our capital a lot more efficiently than the larger funds listed in London, but also we've got technical due diligence to de-risk these assets in this space. Some of the investments on greater than 2 billion, that's really looking at some of the silver mines and gold mines that still offer good opportunity and value because, as I said, the market's risk off at the moment and not investing in precious metal equities. Risk management here, asset split as well. So we try to get a range of investments through different commodities. They all have their own cycles, they all have their own nuances, but what I'd like to stress is that we're not reliant on a higher metal price to make money in these investments. We're investing in development risk in these, or de-risking in these metal environments. This is the portfolio summary, so 87 million, the average market cap 1.7 billion. The range is 9. That's actually just an anomaly because one of our investments got spun out, a gold asset, so we've got that and we're selling. We've got 45 holdings now. 7 have already been taken out. So we're frustratingly, with where the market is, we've picked the right stocks, but because the market's depressed, majors and mid-caps have come in and said, I can take these assets a lot cheaper. So we've made a return on 50, 60% on some of these. We'd like 200-300%. That's the true value of these stocks. We've got a royalty company here as well, so that's giving us exposure into a lithium play in North America. But you can see, again, the makeup of our style. We like developers because we've got a technical background and producers, and then we've got a little bit of optionality with growth through the drill bit and discovery. These are our top 10 holdings. 40% is actually in the top 10, so it gives you a flavour of the conviction. So we spend a lot of time sifting out 40 stocks from a universe that I actively model financially and look at of maybe 150. So this is our greatest hits of mining in this fund. Any new entrant into this fund has to compete with the existing portfolio return that I model. And I model a 12-month exit price on all my investments. And George does the same. You can see this is the suite. So we've got gold and specialty, really. Cameco is actually uranium. So that's our uranium stock, which has done very well recently, with the US announcing that they want to reduce their reliance on Russia for uranium. The market outlook here. So we've got some difficult waters ahead of us. One of them is China reopening and maybe the slowdown in China. What we've done is we've reduced our classical industrial metal investments in this, and they're very beta to global recession. So we've cut our copper and our aluminium exposure. The other side is you're getting clear risk of global recession or stagflation. The Fed says it's going to probably do another 50 basis points rate hike, but they're going to pause first, and then they'll do a hike to see how the economy responds. Gold does very well when you start getting rate cuts. So we position the fund for that event. Obviously, the renewable energy rollout is front and center for this fund, and as over time, what we'd like the precious metals probably to bring it down to about 20%. We'll always have some gold and precious metals in the fund because it's a hedge, and also it's the geopolitical environment is so volatile. We just don't know. So that will do very well, and it will diversify against systemic risk. Then within all these sectors, we've got geological opportunities. So we're selective across all sectors. And finally, I just want to leave you with this chart just to look at here. Regardless of what I've talked about in terms of the supply-demand pinch that's coming, if you actually look at the commodities versus and this is the Goldman Sachs commodity indices, it goes all the way back to 1970. I can take it further if you're interested, versus the S&P 500. Commodities are at an all-time low. We're currently at 0.9 times. If you look at the indices of commodities over S&P, a median reversion will take us up to 4 times, and we don't even have to look at the peaks. So this is why we launched the Amati Strategic Metal Fund, and I think we're in for exciting times ahead. So, questions?
Are you aligned with your innovation partners in Amati? Because some of the people I'm involved with are very hopeful that they'll be getting lithium out of batteries in the next 5 to 10 years because of all sorts of issues with lithium. And there's all sorts of battery technology that won't be using lithium. So are you fully involved with those technology changes that could have a fundamental impact on your investment strategy?
Yeah, I mean, if you want the supply to meet demand, you're going to have recycling in all metal spaces. So at the moment, the leaching of batteries to get lithium out, as you're addressing here, the technology is not there yet. They use a pyrometallurgical technique, which is basically crushing up the battery to a black matte, and then they melt it. At that point, you get all the other metals. You can get the nickel out and the cobalt, manganese, but you can't get the lithium. So what we need is a rolling stock of EVs to go through a life cycle for the next 10 or 15 years, and then there'll be enough supply for recycling. So we're looking at that. I'm doing some work on that at the moment to try and find battery recyclers. But it will be lithium, it will be sodium-ion batteries, it will be nickel, manganese, cobalt. That actually would be, you could look at that as a royalty. In the mining space, you can invest in the miners all the royalties. If I invest in the recycling, I'm kind of de-risking the mining side of things. So I'll look at that if there's no other opportunities and if they're attractively valued than investing in the miners themselves. But we need recycling to balance the equation, that's for sure. Stunned silence.
So thank you very much, Mark. Thank you so much to everybody for coming. I hope that was enjoyable, and hope it's also given you a bit of insight into how Amati has sort of expanded its investment teams. It's interesting the question you raised there. You know, that's certainly something we've debated amongst ourselves. We try and once a week have a group chat together where we get all the investment teams, and we'll be exactly talking about this kind of idea. Well, how's this going to impact over here? What about, are we really going to need all that lithium? What if some new technology comes along, needs something completely different? And that's why it's, you know, for me personally, very satisfying and interesting to have this sort of broader investment set of horizons around us. And I think each of the teams finds that very helpful and engaging. So refreshments are beckoning. It's beautiful weather. I think we're going to be able to go out into the gardens here and continue the conversation. So please do join us. And once again, thanks very much for coming.